Hello, I'm Dan Barnes. Welcome to ActivTrade News. This week we'll be talking about the US rate hike. On the 16th and 17th of September, the Federal Reserve will be meeting to discuss whether to raise interest rates in the US. This is the second most hotly anticipated will they won't they decision for 2015, following One Direction's announcement that they might split. In one corner we have Larry Summers, who has voiced significant concerns about the rate hike, and in the other we have Janet Yellen, the chair of the Federal Reserve, who has been more hawkish on the move. However, we haven't heard from her since markets started to go wobbly back in August. Second, we will be talking about the cause of the crash of the equity markets, both in the US, Europe, and of course China. China seems like the obvious candidate. There are a number of factors, such as the falling commodity prices and exports to China, which suggest that that was the cause. However, that doesn't necessarily explain the fall-off in global equity markets. Next, we will be talking about the Chinese currency. The currency, of course, has been tightly controlled for a long time, but as it's gradually been traded outside of the country, those controls have weakened somewhat. We have seen the Chinese Central Bank and SAFE, which is the authority looking after the currency, step up the concerns amongst banks, saying please check transactions carefully and putting controls into place. However, it remains to be seen how effective that will be. Finally, we will be talking about gold. Gold has seen a massive collapse since 2011, and we have seen institutional investors in the West pulling out of exchange-traded funds en masse. Of course, the US interest rate hike may be the reason for people looking for new instruments to invest in, but we shall see. I'm now joined by Neil Kimberley, columnist for the South China Morning Post. Neil, you've got extensive experience in Asia and the FX markets. Do you want to tell us a bit about your background?
Yeah, then I joined the currency markets back in 1985 as a spot trader, a trainee spot trader. I stayed in spot trading until 2002 at a number of banks. In 2002, I switched over to currency sales at a very large Japanese bank, where I stayed until 2009. Having left the Japanese bank, I transitioned into currency analysis for Thomson Reuters. Stayed there until the beginning of this year, and then currently writing a weekly column for the South China Morning Post, broadly covering currency issues around the world.
Great, thank you very much. The first issue we want to talk about today is obviously what's going to happen with the Fed and the rate hike. If they do hike today, on the 16th and 17th, how much do you think it might go up by?
I think they should do the 25 basis points and let's get this out of the way. I'm sick and tired of this. It's been going on far too long. Central banks around the world are telling them, we know that, get this thing done. And it should be priced. I mean, let's imagine you're a trader. If you don't know this is coming, your boss is going to fire you if you're the wrong way around and they hike. You've got to think about it like that. So the market has to be thinking, worst case scenario. I think the market is underpricing the chance that Janet Yellen's going to do 25 basis points. If she doesn't, the risk is that the Fed's credibility comes into question. The markets think they've got her number. Every time we get close to a Fed hike, the equity market has a little wobble and the Fed thinks again. The Fed is not there to placate the equity markets. As McChesney Martin said back in 1955, we do not seek your applause when setting monetary policy. In recent years, it looks as if the Fed's been setting policy so that people don't cry. We need a little less of that and a bit more Paul Volcker. Get the hike done.
We have seen Larry Summers voice concerns about this. We've seen a couple of analysts in some of the big banks as well. I mean, do you think that they carry any sway?
I think they do carry sway, and I think they've got a very, very valid argument. But you know what? It's never going to be a perfect time to hike, is it? Because you can always think of an argument for not doing so. The question actually for me is, does the economic situation in the United States, which has got monetary policy settings as per the Lehman crisis, emergency policy settings, are they relevant for 2015 when you have 5.1% unemployment? If you can't argue that we're still in an emergency situation, then really we shouldn't have near-ZERP monetary policy in the United States of America. And the fact of actually raising interest rates could both suggest to the wider market or consumers generally that things are actually okay. And secondly, if there is something nasty coming, you've got room to cut. If you don't raise, you can't cut. And it will go into recession at some point. The business cycle has not been abolished because of QE.
And so do you think, is that why you think 25 basis points rather than just say 15?
think 15 points is gesturism. No, I don't do gesturism. Let's get in there. 25 basis points. Let's have a dovish statement to go with it so that the market understands the trajectory is shallow. And let's get back to making some money.
So how complex is the picture for the Fed then in making this decision? Because it sounds like...
It's extremely complex because the Federal Reserve, when it talks about the domestic economy, and look at Jeffrey Lacker's speech last week, the argument against delay.
Yeah.
The suggestions are there that the US economy can tolerate 25 basis hike. Oh my God, it should be able to after 7 years of where we are. But around the world, unfortunately, the world has feasted on cheap dollars. And they have got a big debt problem. So you can understand, I can understand why the possibility of tighter US monetary policy has caused repercussions in the equity markets, in China, in Asia generally, and around the world, because frankly, the price of dollars is going up, whether that's the interest rate you have to pay on them, or the price of the dollar on the foreign exchange markets.
Yeah.
And that's your big problem.
Well, I mean, a lot of the US corporates have got big cash reserves, but of course they're in dollars.
And most of them are offshore.
Yeah.
Buybacks have been funded by loans because they don't want to bring the money back.
Yeah.
Because they don't want to pay the corporation tax. So even for US corporates who have filled their boots with buybacks and they're now long of equities up there somewhere, they've got to manage the situation, and you can extrapolate that for the entire shale oil industry in the United States. You can extrapolate it specifically in China, and we'll go into that later. But essentially, the world owes a bucket load of dollars, and there ain't so many dollars going around.
Well put. So let's move on to the equity market, as we touched upon that. We had the crash in August. The obvious cause seems to have been the Chinese market, but I mean, it has had a very widespread impact on equities globally. I suppose the first question is, do you actually think the crash is over?
No.
Okay.
No.
And secondly, do you think the cause was China?
Partly.
Okay.
I think you've got three facets to this. The equity market is like Wile E. Coyote chasing the Roadrunner. It's gone over the top of the canyon, and Wile E. Coyote's still running. He hasn't realised yet that there's nothing underneath him.
Yeah. China
was the moment he looked down. But China is only a facet of the problem. Loads of money has been borrowed cheaply through QE and invested in the stock market. The world is sated. The world is not buying as much stuff. Look at the freight rates in the container ships. Look at the Dow Jones Transport Index. It's telling you that people have got enough phones, they've got enough tellies, they've got enough jam jars. They don't want any more. And therefore, all these companies who have balled up their shares are finding that the share price is outpacing the earnings, but the borrowings have still got to be repaid. So we were kind of in a false situation. Now China is doing what the Americans have asked it to do for years, is get away from this export economy. Move to your new normal, consumption and investment. Well, I'm afraid that's going to take some pain, as Premier Lee said last week in Dalian. And the whole ballpark has changed. Everything you thought you knew about China is gone. It's a new scenario, but you know what? When you shift from the old normal to the new normal, as traders know, you've still got to deal with the bad positions. And there's a lot of those out there. And that is part of the reason why China suddenly is not buying so much raw materials. That's why currencies like the Aussie dollar have come under pressure. And then the feedback is, you know what, well, if China was the only economy in the world holding this vast edifice up and they're stalling, do I really want to belong to the Dow Jones up here? You know what? Get me a bid, yours, I'm out. I'll take another look at this. Is it over? Of course not. China's still moving into the new normal. Anybody who thinks the Aussie dollar is going straight back up now, really, see a therapist.
Well, we just had the swap over with Abbott, of course. That seems to
I think the Turnbull rally you should be sold into. Political changes don't generally give currencies that much of a fillip for very long.
This is the power of headlines, isn't it? So when we look at risk assets, then what do you think the sentiment is out there? What's driving interest and what's driving?
I think we've got a number of issues. I think there's aggregate demand. He's not there for the reasons I think. I'm looking at the freight rates, I'm looking at the trains, I'm looking at generally level of indebtedness around the world. I mean, picking on China again, the BIS said over the weekend that Total debt to GDP in China now is 235%. That's gone up 82 basis points since 2007, and that's all been fueled, in my opinion, by cheap dollars. But essentially, if people aren't buying the stuff, then the debts have still got to be paid. And where's that going to come from? Around the world, aggregate demand is suffering. You can see in the commodity currencies, it's been a major play. Aussie's rise was a proxy trade for China. It's not now. Well, actually it is, but in reverse. And around the world, the euro's up at 113, 140. Really? Do you really think that is such a good bet when the Federal Reserve is on the verge of tightening policy and the ECB is now talking about extending quantitative easing? Do you think the Europeans want the euro at 115? The last time we got here, they started talking. If I was a trader, I'd be looking at the levels to get short of euro. Yes, the capital's come out of Asia. Yes, it's come back to Europe. Is it going to stay here? No, I don't think so. It's a way station, like Mark Carney called the interest rate policy the other week. It's a way station. It's stopping here, it's taking a breather, and it's going to move on. And where's it going to go to? You know what? If we get the Federal Reserve hike out of the way, 25 basis points, and a dovish statement, you then know that the Fed's not going to hike anytime soon. And you can lock in to US dollars at that rate. You can lock into US paper, and you can sit back and take a look at this for a while, because you know that for all the talk about the yuan and the euro and the Japanese yen, the one thing you want in your wallet is a greenback. And the picture on it is Benjamin Franklin, $100 bill. He's your best friend. He will be for the conceivable future, in my opinion.
So, what does this mean for China's open market policy then, if we take it across to the yuan?
Let's look at the yuan. Let's look at where we were back in 2007. The Chinese have been responding to American pressure over the last decade or so to open up their economy, move away from this export-driven model, and the Chinese have gone along with it. The yuan has strengthened over the period we're talking about, 07 to early 2015. At the same time, the Chinese economy has been booming. So interest rates in China have been very high compared to the rest of the world that was still struggling with the post-Lehman. US interest rates were down to zero nearly. So tell me, if I'm a trader, it's a no-brainer, isn't it? Here's my situation. I can borrow in dollars for near nothing. I can then sell those dollars on the foreign exchange market and buy into China one way or the other. Aussie, blah, blah, it doesn't matter, but basically I want to play it. I'm going to pick up my Chinese yield. At the same time, I know, because I can see in my eyes, that every day from 2007 onwards, the Chinese central bank has been allowing dollar yuan to move down. The yuan has been strengthening. So not only do I get a pickup in the yield, I'm in a situation, and traders got this very early on. If I borrow dollars today, I think I know that in 12 months' time, dollar yuan will be lower, so I can buy the dollars back with less yuan and I make even more money. That has encouraged behaviour in China with which we are now having to deal. Just think about it. Japanese importers before Abenomics, they thought they knew that dollar yen will be lower tomorrow than it was today. So you know what? The dollars I need to buy, I'll buy them tomorrow. Japanese exporters thought the same, so, oh no, I better sell today because tomorrow's going to be lower. In China, we had a situation where the Chinese importers needed dollars. But they thought they knew, that the dollar yuan will be lower tomorrow than it is today. So as a trade, I'll buy tomorrow. Chinese exporters didn't have that luxury, so they had to sell the dollars that were coming in. At the same time, both sides are borrowing in dollars and piling into yuan investments. Now that's the old normal, and it worked beautifully until the new normal, which the Americans encouraged, began to click in. Now we have a situation where the PBOC is going, hang on a second, we've got 3 point blah blah trillion of reserves here. It's a lot of money, a lot of moral hazard. Where do we put them? Remember, they got burnt on the euro, big time. Do you want that level? Secondly, there's a tremendous amount of debt in China. And thirdly, as you switch away from the export model and you free up your capital markets, as we all ask them to do, dollar yuan becomes a two-way trade, baby. dollar yuan can go up as well as down.
Yeah.
And initially this year, the People's Bank lent against it. But eventually, the capital outflows, people repaying debt, people in China understanding, you know what? The Fed might hike. China's been easy. I'm short of dollars. I better get some in. And they move the dollar higher. And the PBOC leans against it, and leans against it, and leans against it. The reserves are dropping, and then suddenly somebody wakes up in Beijing and goes, you know what? We can't keep doing this. We can't keep doing this. We've accumulated all these dollars, and now they're walking out the door. I saw the same thing after Lehman's with some other central banks. There comes a point where you can't lean against it anymore. But once you don't lean against it, once you change the regime as they've done, and you allow the two-way trade, then the behavior of everybody who's trading the yuan has to change with it, especially when they're wearing dollar debt.
So if we look at the new normal then, what does this mean for Chinese companies who have to hedge their currency risk?
They're doing it now. Anybody, and don't look at the spot. The traders out there who are using ActivTrades will be looking at the spot.
Yeah.
You need to look at the forwards.
Okay.
Because even this morning, I was talking to guys in Asia who were seeing onshore companies taking outright positions. It's the forwards where it's going to show up. Because the spot, we know it's plus or minus 2%, and the next day we'll fix it about where it was just at the close before.
Yep.
Which incidentally means if the PBOC does want to push it down, they can do so in the last 2 minutes of trading, and then we can start the next day. Yeah? We've gone from setting the fix to fixing the set, essentially.
Yeah.
But that's what they've got to do. And all of a sudden, Chinese companies, exporters, importers, are seeing the reasons for holding the yuan lessen. They're seeing the costs of hedging rise because we've now got two-way volatility.
Yeah.
But thirdly, they're understanding that they've got to do it. And now that's changed the whole damn game. This is not a one-way bet anymore. So yes, they're going to have to do more hedging. Yes, they're going to have to learn quickly how they can do it. But the key point is they're going to have to do it. Whereas in the past, to a large extent, they felt they could wait. And that's the big difference here. China is joining the rest of us. And if the rest of us thought it was going to be an easy ride, we were really deluded.
Yeah. And so you say it's a two-way bet now, dollar yuan. Does that mean is there the potential for further devaluation on the cards?
Well, think about it this way. You've got to think about China and the whole Asian situation.
Yeah.
If the yuan, and this is important also for people who are trading through ActivTrades, because what happens in China percolates right through. I wouldn't touch any of the emerging Asian currencies with a barge pole at the moment. They've gone a long way, but why should they stop? And because there is not the liquidity in the marketplace, and this goes also for the majors. I mean, the price action in the Kiwi the other day was indicative. You're going to get these spikes in prices.
Yeah.
So it's good that something like ActivTrades has got the security policies in place to protect the clients.
Yeah.
This is important. It's one of the major reasons I think for using this company is that you've got protection behind you, that somebody's watching your back. But essentially, if you're sitting in Malaysia or if you're sitting in Korea, you are worried that you are going to lose competitive advantage against the yuan. You've already lost it against the Japanese yen.
Yep.
And by the way, have you noticed how American politicians are screaming blue murder about a 1.87% one-off recentering of the yuan exchange rate and said absolutely nothing about a 30% decline in the yen?
Yeah.
Tells you everything you need to know about Abenomics and the relationships that are in the Far East. But essentially, many people in Asia, and I'm thinking specifically of Korea, they lost a tremendous amount of competitive advantage against Japan, and they're worried they're going to lose it against China. And consequently, their currencies, their people start to react and the dollar moves up. But also, because it's a global problem, they've got exactly the same issues as the shale oil guy in North Dakota who's over leveraged, over borrowed and looking at $48 a barrel. As the guy in China who's borrowed a truckload of dollars and is thinking all of a sudden, this ain't looking such a good bet. Everybody's got the same problems. They're all loaded up on dollar debt and the bills are coming in. So everybody's scrambling for dollars. And that is going to be the key issue. Big problem for Europe as well, because the euros here at 113, 112, 113, 114, but you look against the euro against the yuan, or the euro against the won, or euro yen. Do tell me how the Germans are going to sell more stuff into Asia with the euro so strong against these currencies, because I'm struggling to see how that one plays out. And I don't think that's priced yet. And I think the euro, to me, I don't get it. Don't get why it's up here. Why are you confident? The French data is telling me, just yours, give it. This baby's going down. And if the Fed hikes, I think that may start to coalesce the opinion. We have the Fed here, we have the ECB probably doing more QE, because frankly they're going to have to. Why is the euro here? Why shouldn't we be going back towards parity? I wouldn't be long of euros. And because I'm so bearish on the global situation, I wouldn't be long of commodity currencies either. I think the Turnbull bounce in the Aussie, I'd be selling it, to be honest.
Well, we always have gold, which is no longer in its salad days. Do you think that the cycle of gold, we're now into a cycle of underperformance with gold?
We are. Gold, was favourite for a long time. Everybody thought that central banks were buying bucket loads of it. The data from China earlier this year suggested that they hadn't bought so much bullion as we thought they'd purchased. And the thing is with gold, it doesn't yield anything, does it? It's not a barbarous relic as Keynes once described it, but you need a reason to buy it. And if the Federal Reserve is about to tighten rates, and Janet, if you're watching, I'm sure you are, Janet, come on, let's get it done. If they are going to tighten rates, then the cost of running your long gold position has gone up. So if you want to run longer gold, and as again, I say I've got a background in the Japanese bank, so I'm used to token, where people buy gold and sell yen, or sell gold and buy yen. You've got to buy it in something else. But of course, we fixate on the price of gold against the dollar. And given that I'm a dollar bull, and given that I think the dollar is a commodity like anything else, I can't see why the gold price is going to get a massive fillip unless something really horrible happens. Now, if we are in a global disinflationary scenario, and fiat currencies, as we're seeing in Asia to an extent, are being questioned, then I could see some people buying gold again. But I'm not really seeing the whole inflation picture unfolding yet. It will do, because the money that's been printed by the Bank of Japan, the Federal Reserve, and the ECB, and the Bank of England will eventually cause a problem. But at this point in time, I think it's a brave man that goes too long of gold. I've been playing it from a small long side, but probably against another currency other than the dollar.
Okay, that's great, thank you. And so looking ahead, this week there's pretty much only one game in town. We're looking at our calendar, and that's the Fed on the 16th and 17th, and we've discussed it already. You made your position clear in terms of what Jan should do, certainly. Are there any perhaps repercussions from that we should be looking at on the calendar? Or
I think this is the key, because if they don't go, then we will then obviously be talking about, are they going to go in October, or are we going to have to see what happens in December? Markets don't like uncertainty. My worry is that if they don't go, the market will decide that they are really worried about something, the Fed's really worried about something that we are not aware of. And that will cause more problems in the equity markets, and more problems in fixed income, and more problems in the currency markets, which would then lead their decision to be more difficult towards the end of the year. And then I think people have forgotten, next year's a presidential election campaign. Very difficult for the Federal Reserve to do too much once the primary is out of the way, because they won't want to be accused of interfering in the US presidential political process. So I think the window for them tightening, and the IMF said this is probably the most widely heralded tightening of monetary policy in history. The window for that is shrinking. They've already told us they're going to go in 2015. I think it's carpe diem. Seize the day. And if you don't, be prepared for those unknown unknowns coming back to bite you. I think a failure to hike could encourage more volatility, more gapping, more flash crashes than actual hike.
That's great, Neil. Thank you very much.
Thank you.
Thanks for watching ActivTrades News. We'll be back next week for more economic and market updates.